What do you know? We're back to the lobster farm. You may remember the story of the small little lobster, and you, as a growth investor, want it to become bigger and bigger, and you invest and you take an ownership position. Maybe you invest enough to have a quarter of the share of the lobster, but it's a quarter of the share of the lobster no matter how big it gets. That's why you're a growth investor. Well, there is a small problem. The farm owner needs more money, and they know that you don't want to give up your share of the quarter of the lobster income that you're going to get later on when the lobster is sold. So the farm owner says, let me see what I can do. Oh, wait, the lobster lays eggs. It actually lays a lot of eggs. And the number of eggs is not constant and it varies. So the lobster farmer says, what if I created a tomato farm program kind of thing inside of the lobster farm? I'm going to sell the rights to the first dibs on eggs for anybody who wants to participate on that program. So the existing lobster investors say, hey, as long as I get a quarter of the price of the lobster when it's sold, I'm good. The lobster egg investors say, as long as I get 1,000 eggs a quarter or whatever it may be, that's what I'm in it for, I'm good. That is the preferred stock. The preferred stock gives priority in dividend income. It says when there are eggs, and sometimes they may be, sometimes they may not be. When there are eggs, you get priority in the first 1,000 eggs. When there are more than 1,000 eggs, then we're going to give it to the growth investors. And so the growth investor is happy and the tomato farm investor is happy. Now, in a convertible preferred stock, you get to trade some of your eggs and baby lobsters from the eggs for a share of the giant lobster. Listen to Yield Nerd, and we're going to talk about preferred stocks soon. Thank you.